Hi guys, my name is Hanspal, and this is a very quick video where I'm trying to make you understand about the current market scenario, be it from the equity perspective or the fixed income perspective, ideally. So it would be a very simple video. I won't be going into the huge dynamics of the stock market or the fixed income market, and I won't be indulging myself into the various complexities and using a large amount of technical jargons to make you understand. So just to understand the market, the current state of the market, just through a few of the numbers, a few of the charts, and what ideally we can prefer to do, right? So it is just an informational video, I would say, just for the purpose of education, so that you guys can make an informed decision and you guys can ideally know that what is happening in the market in the current scenario. So currently we can see that the market started to correct, right? Beat the Nifty 50 or the Sensex, and we also saw the mid cap and the small cap index coming down, or crashing would not be the right word, but correcting by more than 10-15%, right? So in the previous year, we saw the mid cap index rising by more than 50-60% and small cap index rising by more than 70-80%. 80% was the precise number to be very exact. But now that small cap index has corrected by 20%. So that is the small cap index is still at a high of 60%. The small cap index, it gave you a return of approximately 80%, and currently the small cap index corrected by 20%. But still it is above the 60% mark. Correct. And investors like who have been investing into small cap or mid cap, they have been really panicking that what to do next. And we also had the discussion by the SEBI chairperson, like who was very well concerned about the inflows into the small cap and the mid cap, because not all the small cap and the mid cap stocks would be fundamentally strong. Because recently we had the Mahadev scam. So what happened in the Mahadev scam? The people were concerned about the pump and dump scheme, because the huge people got involved. A group of the people got involved and they pumped some particular stocks. And we as people tend to invest into the particular stocks when it has already reached that pump, that inverse U shape. And when we tend to invest into that pump point, those people who have accumulated their money or who were a part of the scam, they tend to sell off their shares. And we as the retail investors make losses. So that is something the CB chairperson was concerned about and the management was concerned about. So like that was the reason they came up with the stress testing. So stress testing is something which is once again creating a panic among the retail investors. The FIIs are very well aware of that. Mostly they tend to put their money like into the large cap. But the people who have the understanding, the background and experience in the market, they are not getting panicked by the stress testing. Stress testing is something which the SEBI has not done for the first time. It used to happen earlier as well. It has been happening from previous many years from 2008. But it has been only the first time when the results have been made public. And I'm repeating the same point. Stress testing is not something that has happened for the first time. It has been happening from 2008 or maybe some year prior, but the results have been disclosed and all this information and the people have been starting to talk about these things for the first time. So there is nothing wrong with the stress test. Like you might be seeing numbers all around you, people talking about the tenure or the days in which a person can liquidate 25% of his small cap or mid cap portfolio, or 50% of the mid cap or a small cap portfolio. And the days might get differ starting from 3 days to 60 days per se. That is just one thing. It used to happen prior as well. But people have started to talk about, or these numbers have come out in public for the first time. So nothing to get panicked. It doesn't mean that the small caps are bad or mid caps are bad and only the large caps are strong. So coming back to my previous point, not all mid caps are bad, not all small caps are bad, but a few of the mid caps and small caps can be bad as well. And bad is a very harsh word, I tend to understand, but they can be bad and they can tend to erode your wealth as well. So whenever you are investing into a particular stock or whenever you are investing into a mutual fund where you yourself are not picking up particular stocks and relying upon the capabilities of the fund manager. So whenever you are picking up that mutual fund, try to see those stocks as well, at which stocks that a fund is investing into, especially from the mid cap and small cap perspective. Because a large cap ideally will give you a generalized return, maybe a kind of a return almost same as a Nifty 50 or some points here and there. There might be few years in which the large cap might outperform and give you a two-digit double growth, but ideally, in most of the time, they won't be giving you superficial returns, right? As the potential which the small cap and mid cap have. Here, I'm not saying that large cap cannot give superficial returns. They can also give superficial returns, but not always. You have to pick up categorically specific companies which can give you that higher return, that higher growth rate in your returns. But the potential for a small cap and a mid cap to give you a higher double digit growth, or in some scenarios, a triple digit growth is much higher. So that you need to understand, because there's a high possibility that 15 to 20% of the small cap stocks in small cap index get added to the mid cap index. 5 to 10% of the mid cap index stocks get added to the large cap index. It is a very high possibility. And the vice versa is also true, that a large cap company might get out of the Nifty 50 and Sensex, and a mid cap company or some other company from the Nifty next 50 might enter into the Nifty 50. That's the process that we ideally call it as rejig, Nifty rejig, REJIG, Nifty rejig. 2 or 3 stocks on a quarterly basis or on an annual basis, they get rejected. They get kicked out of Nifty 50, and new stocks from the Nifty next 50 get added to the Nifty 50 index, right? So even when you are investing into Nifty 50 or large cap companies, you need to be very well worried about or concerned about which companies you are investing into. So that is where fundamental uh, research or fundamental analysis comes into place. Be it for large cap companies or mid cap companies or small cap companies, you need to do fundamental analysis. Or if you don't have time, just try reading the research report of these companies. How is the profitability of these companies? A higher metric cash flows, because the profitability can be manipulated. And I've told this multiple times. The company can forge some sales, the company can forge some revenues, the company can minimize costs, which ideally the company might not be doing, and the company can inflate those numbers. The company can boost fake sales, fake orders, as popularly we talk about in forensic accounting as channel stuffing is the popular term. But cash flows is something which the company has actually received. It might happen in these mid cap and small cap companies. The profitability for one quarter might be too high because they have done that channel stuffing, posted fake orders and fake sales. But in the subsequent quarter or the annual results, the profitability might drastically come down. It might not happen so much with large cap companies because people are tracking them 24/7, but can happen with small cap and mid cap companies. So whenever you're looking towards buying or taking a position or going long towards a small cap or mid cap stocks, focus upon free cash flows more than the profitability. Debt is one such aspect. Higher debt is not always bad. It can also help you to boost your EPS, to boost your ROE also, right? But the ROC might come down because of the huge denominator figure. But a huge debt can also be positive to boost your EPS till the point of time the cost of debt is less than cost of equity. So you need to be concerned about two numbers for a mid cap or a small cap company. And all this analysis can be done for large cap also, right? But why I'm focusing upon small and mid cap more? Because people are concerned about the small stocks and the mid cap stocks currently, right? So always look at the cost of debt and cost of equity number. So till the time the cost of debt is less than cost of equity, the rise in debt will have a magnifying effect upon the EPS of the firm, and EPS denotes the earnings of the firm. So that you need to understand. That is a very important metric, and all these numbers are publicly available on the annual report and simply on Google as well, on different platforms, on different websites. It's not a paid data. Okay. So these things you have to understand. Like you have to see what the management outlook of the company, how far the company is going towards diversifications, expansions, acquisitions, and mergers would be less. The possibility for a large cap acquiring a mid cap and a small cap is high, but a mid cap and a small cap might do some mergers like among themselves, but they won't be acquiring a large cap. Common sense, right? So these kinds of businesses you have to understand whenever you are doing individual stock picking. I understand for a mutual fund, like you won't have time to track like each of these stocks. But at least once you start tracking at least 2, 3, 5, 6 stocks and reading the annual report, like you yourself will become confident. You yourself will try to understand. Here, I'm not saying you that you need to know how to calculate the forward price to earning ratio, price to book value ratio, free cash flow. These numbers are also publicly available on Money Control and different social media websites. Not to worry about that. But just to read these numbers, just you need to know how to compare these numbers from the past averages and from the different businesses within the same sector, right? if I talk about like one sector per se. Nifty small cap, mid cap, again do fundamental analysis, try to understand valuations, try to compare multiples, because even if these mid cap and small cap being higher by more than 50%, 60% currently, they trade at a forward 1 year multiple of 26x or 27x, price to earning multiple I'm talking about. There has been times in 2017, 18 when they used to trade at 120x and 140x. So still we need to understand that whenever they're trading at 27x, 28x, it is far below than their historical price to earning metrics of like 120x or 130x. So I will just share my screen with you so we can just talk about some numbers and we can just discuss about the same. And all these numbers is not a huge, I would say, research I've done upon that. And the same thing that you guys can also do for. All these numbers are publicly available on Google. So if you just type in simply Nifty 50 का value देखो आ गया. If I just talk about Nifty 50 price to earning P, so like you'll be having multiple websites telling you, right? So if I just go to the first one, trend line, ठीक है? So trend line में वो क्या बोल रहा है? The current price to earning ratio is 22.7 for Nifty 50. ठीक है? Price to book value, ideally, I do not prefer for the whole Nifty 50 because it comprises of, agreed, the banking companies also, and the banks having the maximum weight like into the Nifty 50. Correct. So the thing is that when you are talking about all the stocks and not specifically about the BFSI space, it is more preferable to use a price to earning. If it had been bank Nifty, then I would use price to book value and not price to earning, because book value is a better indicator because it tends to take into consideration the book value of the loans, all those NPAs and the provisions into account, like which the bank or the BFSI companies have kept in space to hedge themselves from the downfall or if someone defaults on such loans. So 22.7 historically past 10-year PE has been around 1920. So we can say the market is overvalued, but not sheerly overvalued. Still, it's a good time to put your money, right? It's not a bubble. So see, like all these numbers are here. It's below the 5-year average. The 5-year average has been 22.74. Correct? It is 22.7, almost same. So we can say it is almost at a fair value. Correct. So all these numbers you guys can compare. Comparing 1 month, 1 year is not so good. Like minimum 5 years, like you must compare. And all these things you can compare. Even see price to book. Price to book, if you just compare it here, it's 3.9. It's again the below 5-year average, which is how much? 3.86. Almost at par, we can say. Fair value. Right? And all these numbers can be seen by chart. So as of March 15th, the price to book value was 3.86. If you tend to see price to earnings, it had been how much? It has been 22.86, right? Nifty PE and Nifty value. So all these things are clearly mentioned to you here. So these things are very simple to understand. You guys can go through on your own as well. And the same thing what we can do, the same thing we can also search in Google, because here I'm not making it complex calculations. It's a video just for the general investors who do not have time or that deep intensified knowledge to do the research. So Bank Nifty price to earnings. I do not rely upon price to earning for banks. Okay, the reason I told you. I'll go for price to book value because price to earning will not give you a fair indicator. It will always be high because that won't be trying to consider the book value, the debt and the provisions like which the bank has created to hedge itself from the default if someone commits. Again, price to book, you can see kitna chal raha hai. It is 2.71, almost at fair value. A good time you can think of buying, and do not rely upon my opinion. This video is just for the information purpose. I'm not forcing you to buy Bank Nifty or Nifty 50. Okay, it's your call. So all these numbers can again be compared in a similar way. Similarly, the dividend yield can also be compared. So all these things can be clearly compared. Right? So here we can say that Nifty 50 and Bank Nifty is almost fairly priced. And the same analysis you guys can do for healthcare, which I believe it's fairly priced because I've seen all this and done the research upon that. Even your telecom and media seems to be fairly priced, right? Your IT seems to be overvalued, be it the mid cap or large cap. Even if you talk about the defense space, again, it seems to be overvalued. The public sector units, the PSU space or PSU banks, again tend to be overvalued because they are given more than 100% return. Individual companies give more than 300% returns in previous years, right? So same kind of analysis you guys can do. And if a particular sector is overvalued, it doesn't mean that you cannot purchase companies into that particular sector index. You can still pick up individual stocks. It can happen that a particular sector index is overvalued, but a few of the companies within that particular sector are still undervalued or fair valued. So ideally, we are taught in finance that buy undervalued or fair valued stocks, but we can also purchase overvalued stocks in real life circumstances if the earnings, cash flows, profitability, future prospects of the management, and other parameters are in line. Even it is good to purchase an overvalued stock if its valuations, not the valuations, but earnings, cash flows, and different other metrics in terms of liquidity, debt, the management outlook, acquisitions plans, all these are supporting the company so that you need not lose the returns. And that is why it's preferable to create a portfolio rather than investing into stock, because that will reduce your variance. But the interaction between the securities can be like plus and minus, and that is a covariance among the securities like within the portfolio. So that we need to understand. Correct. So that was about equity perspective. Nowadays, like we have been talking about the fixed income as well, right? Because the Fed was about to like reduce the interest rate. Like people believe that the Fed in US, because most of the countries follow Fed, right? The Fed in US would be reducing the interest rate by the first quarter, right? And they were waiting for the data for inflation, the wage growth data, the unemployment data. So all these data have been like pretty strong. So basically your inflation in US has been around 3 to 3.1%, but the Fed wants to make it down to 2%. Again, the unemployment rate has gone down. The wage growth is not rising by at par, but the wage growth is rising by a figure value. It's not too much higher, but the unemployment rate has come down, right? So the Fed is still waiting because the unemployment is rising and inflation is still not at the target like which the Fed wanted, so that it can reduce the interest rates, right? So that is the basic scenario that is happening, and all the banks, all the country central banks tend to follow the Fed. Because ideally, what we can see, like in a scenario when the interest rates are bound to go down, people tend to take position in long duration. They tend to purchase the long duration bonds and sell off the short duration bond so that they can lock in the yield in long duration. And vice versa happens when the interest rates are about to go up. People tend to sell off the long duration bonds and purchase the short duration bonds. So that is also called a duration management, which the portfolio managers do for their portfolio. When the interest rates are about to go down, they will adjust the duration number, which is nothing but the inverse relationship between the price of the bond and the yield. I've talked about that in my various LinkedIn posts and sessions as well. They will try to manage the duration in such a way so that they can have, for example, if the current duration of the portfolio is 5 and the interest rates are expected to go down, they will sell off the current portfolio, buy a portfolio of longer duration bonds having a duration of 10. So if the interest rates fall by like 1%, the value of the portfolio will rise by 10% instead of 5%. So that is a duration management for portfolio, right? In terms of fixed income. Correct. So currently, if we talk about US, because most of the countries that will be following US, we can see an inverse yield curve, right? And why an inverse yield curve? Again, these numbers you can follow, because what is an inverse yield curve? When the short term interest rates are higher than long term interest rates in terms of government bonds. And what's a rising yield curve or a steepening yield curve or a widening yield curve? When the long term yields are higher than shorter term yields. So currently, the shorter term yields are higher than longer term yields, which is creating an inverted yield curve. And whenever the long term yields are higher than short term yields, it creates a rising yield curve, right? So even if we see the positions of yield curve, everything is freely available on Google. I'm not drawing anything per se to make it very general for investors. See, so first one, it's a rising yield curve. The long term rates are higher than short term rates. It's almost a flattening yield curve, this one, where the long-term yields are almost at par with the short-term yields. And this one is an inverted yield curve, and the short-term yields are higher than long-term yields. Basic Google information, all you guys can find through that. And how I can prove this? If I just type in here, see, US Treasury 2-year yield. And I just go to all on CNBC US link, you have it 4.732%. So remember, the 2-year yield is 4.732%. If I just type in here as 10-year yield, 4.7, this is 4.3. The 10-year yield is lower than the 2-year yield. The longer term yield is lower than the shorter term yield. And difference almost of how much? Difference is almost of 4%. 0.0, like 0.4%. Correct? So that is ideally the difference that is going on. Okay? Now, ideally, it is a negative. The spread is negative. Correct? The spread is negative, and people are fearing recession. But the thing is, now everyone expects it to be a soft landing. That is, the huge recession won't take place. The Goldilocks scenario won't be there, where like everything is good and the market is hugely rising. There is huge employment and like inflation is currently down at 2% or like 1.5%. The Goldilocks scenario will not be there. The recession will also be not be there. Somewhere in between soft landing is there, because earlier this inverted spread, the difference was very high. Instead of being minus 0.4%, it was 1%. It was minus 0.8%. But now in the next quarter, they're expecting the spread to widen, right? Widen to plus 0.4%. Because currently it is narrow. It is narrow. The yield spread. So yield spread is the difference between what? The yield spread is the difference between the yield on long dated government bonds minus the yield on the short dated government bonds. And whenever the yield spread is contracting, we have an inverted yield curve which fears a recession. But whenever the yield curve is expanding, right? In this case, it is -4. It is contracting, but we are expecting it to be +4, plus 0.4% in the next quarter, which will expand it, right? Which will assure a soft landing. So be it if it is not 0.4%, they might almost come at par, or it might be a flattening yield curve. But the shorter term yields are almost at par with longer term yields. Even 0.4 is almost a flattish yield curve, which I believe. It's not completely inverted. It is somewhat inverted, but closer to flattish, because it's closer to zero now, minus 0.4, right? Flattish ho gaya. So there will not be a recession, but there would be a soft landing per se. Correct? But like when we see the 30-year yield, so that's a homework for you. 30-year yield is much higher than 10-year. So that you can see in the long term, the growth perspectives are high. Okay, so just look at this number. So that's a quite homework for you. But if we talk about India, I was just looking the numbers of India this morning. So quite shockingly, if I just see India may ideally we tend to say India government bond yield, 10-year bond yield. So currently it's at 7.062. So just remember this number. Long-term yield 7.062. And shorter term yield कितना चल रहा है? Same website 7.047. Almost at par. Almost at par. It's already flat. It means the condition of India is much better as compared to US. And that is where people said that the fear of recession in India is close to 0%. And the fear of recession in US is just 20 to 30%. The last it was 90%, but now like it has come down to like 20, 30%. So India, in terms of yield curve, is in a better shape rather than US. But US again can do well. Talking about European markets, again, the European markets are expected to outperform the US markets because they're expected to reduce the interest rates before US, not following the Fed, but taking an individual stance. That is one thing that they're planning to do, because inflation is coming down at a very fast pace there, at a very fast pace there. The growth numbers are good. The companies are delivering huge returns. The banking system is becoming strong. Infrastructure, manufacturing is like coming out to be strong, and people have started to bet more, going long towards Europe. Japanese markets, again, they fear the recession because Japanese market were again high after 39 years. And the previous history showed that when the Japanese market was as high as 30, as all-time high, it crashed by 60%. Because the working population is average age is more than 50 to 60 years, because that's a fear that the Japanese are fearing. So a complete recession has not taken place, but it's a fear or a partial or a soft landing kind of a stuff happening in Japan. And they're also expecting to increase the yield on the Japanese bonds, on the treasury bonds, because we had close to zero, almost negative rates were there. But now they want to increase it to at least 1%. Because the Japanese yen was being undervalued. Because agreed, undervalued currency like is good for exports as well, right? But you need to have people like investing into the fixed income securities of Japan. So if the yield is rising ideally, people will tend to shift their money from Europe or US and tend to like invest in Japanese bonds, right? Into Japanese government bonds. So that is one more concern that is going on. So yield spread, we talk about the difference between the long-term government yield minus the short-term government yield. And here we just talk about government bonds only. Corporate bonds are not included. For corporate bonds, we have a separate term that is a corporate spread. So that's a difference between the yield on corporate bond minus the yield on government bond having same maturity. So I told you when yield spread expand, that is the difference in a 10-year government bond minus the difference in a 2-year government bond expands. It's a prosperity phase. It's an economic boom phase. But when the yield spread contracts, it's a fear of recession. The vice versa theory is for the corporate spread. When the corporate spread rises, there is a difference between the yield on corporate bond and government bond rises. It's a fear of recession, like going back in time. But when this corporate spread is contracting, the difference is contracting, it means it's not a fear of recession. It might be soft landing or a period of growth. So currently in US, we can see the yield spreads are about contracting because are expanding because they're going from that -1% range to -0.4 and 0.2. And the corporate spreads are also coming down. The corporate spreads are coming down. They are narrowing and the yield spreads are expanding. So that's a good signal, right? Because whenever there is a fear of recession, people tend to purchase the treasury bonds. And whenever they tend to purchase that treasury bonds, so what basically happens? Treasury bonds will have to give you a higher return because people are pricing in that risk into that return. So what basically happens when people tend to purchase your treasury bonds, the price of treasury bonds rises and the yield falls, right? Yields are falling. Yields are falling. The fear of recession is there. The fear of credit risk is there. People are purchasing the US bonds as safe haven. When you are buying something, the price of the US treasuries rise and the yields are falling. Yields are contracting. But there, the corporate spread yields are rising. Because again, the corporate bonds are also pricing the credit default risk because whenever there is a recession, it has a contagion effect, a spillover effect to the other companies that might default, right? But in this case, now people have started to sell off the treasury bonds, right? Those long duration treasury bonds, they have started to sell off. The selling of those they have sold off the short duration bonds, correct? So treasury bond, they are selling off. The price of treasury bonds is coming down, correct? And the people have started to purchase the corporate bonds because, again, like what is happening? Because people are not fearing recession. They feel that it would be a soft landing. Then why to go towards the safe haven? They're now purchasing the corporate bonds, correct? But this inverse relationship of demand and supply, it won't take place in one day. It takes place over years and years and years, 3 to 4 years, correct? Minimum 2 years, max to max 4 to 5 years. So that we need to understand. So ideally, people are purchasing long duration bonds. Since the Fed has indicated that it might not that it will not reduce the interest rates in first quarter because we are already at March end, like we have crossed 15th of March 2024. And in 2024, like we are entering into March. Correct. So earlier the expectation was the Fed would reduce the interest rates in first quarter. In first quarter, the interest rates would come down. But now that's not happening. Still, people became duration neutral. They also started to purchase the short duration bonds because earlier they hoped that the Fed will come down, the Fed will reduce the interest rate in the first quarter, right? And they started to purchase the long duration bonds. But once they found out the slower down of interest rates can delay, they found themselves overbought in long duration bonds. So they started to sell off the long duration bonds, or they held some positions in long duration bonds and also started to purchase the short duration bonds so that they can hedge themselves from both the interest rate fall and the interest rate rise. So trying to make this number of duration neutral in their portfolio. So the quantum of the short duration bonds currently would be less because we're entering the second quarter. But in the previous 2 months, it was almost at par, or maybe in some portfolios, the short duration bonds might be higher as well. But in majority, I suppose the long duration bonds composition would have been much higher than short duration bonds. So that we need to understand. So that is one thing that is going on. People, investors, the PMs have started to take positions, right, in the secured credit, long-term credit positions they have taken, also taken short-term credit, risky short-term credit into bonds like lower than BB, which is non-investment grade, right? They've started to take positions in securitized debt, in mortgage-backed securities, agency pass-throughs, and non-agency pass-throughs. Because in long term, these can be risky because they have a fear of default, but in short term, they might give you a higher rate of interest. So trying to hedge your fixed income portfolio both from the shorter term perspective and longer term perspective. The rise in interest rates and the fall in the interest rates. And similarly, they have been taking positions in equities as well in different markets. In Europe being 20%, like in most of the companies have started to take, US being around 15-10%, China some 5-10% exposure, right? Indian markets, people have been conscious because of the higher multiples, because is the market highly being driven by the by your DIs, your domestic institutional investors, and not by your foreign institutional investors, right? Because ideally, the FIIs to this point of time, they're still the net buyers, right? But the quantum of their investment into this Indian market is not so high, right? So that is one thing that we need to understand ideally in this scenario. So trying to talk about the different markets, I try to talk about being overweight in Europe, ideally because of the outperformance, which we expect. Talking about the US markets as well, the Indian markets per se, being good from a longer term portfolio perspective. Again, like if I talk about the fixed income, they have been the currently, like if we talk about fixed income, it had been a bull steepener curve ideally because the short-term yields are falling higher than long-term yields. The different types of bull steepening strategies or the yield curve strategies that we can discuss later. But currently what we see is a bull steepener ideally. So that is being one more thing. In Europe, like more positions they have started to take in the crossover credit segment. So what is crossover credit? I've tried to post a separate content on that. So just go back through that and just try understanding. So currently, fixed income, they're trying to go towards long duration, ideally, with something is being preferred. And this is not a recommendation to everyone. It's just something that you guys can look through and find something easily available on social media platforms and take an informed decision. So that is something ideally that you need to know. Okay. So this is the data which I just tried to talk about. And again, just a last point, like recently we had the GDP and the GVA numbers, right? And there was some discrepancy in the GDP number, which I believed, right? Because GVA is nothing but you subtract your indirect taxes plus subsidies, correct? So GDP minus your kinds of indirect taxes plus subsidies, it gives you the GVA number ideally. The GDP numbers ideally, sorry, GVA, adding you back your subsidies minus your indirect taxes. Right. So currently the subsidies have been falling because of the lower fertilizer prices being fallen down by more than 60%. Indirect taxes are rising. The component for personal consumption in GVA calculation is 7%, and the component of personal consumption in GDP is just 3.5%. Huge disparity. Factor method gives you like some other number for GDP calculation. Expenditure method is giving you some other number. Huge disparity between both these numbers, which can be like grilled upon and can be looked into. So these numbers are also something that we need to check from your mindset. And I'll be posting a separate article for the same. I've posted something on my LinkedIn account for the same as well. So these things you need to know. Try understanding the equity markets from a very good perspective, trying to understand these things, trying to understand the fixed income market from the India perspective and US perspective as well, right? The different fixed income instruments, the current valuation of the market, and which stock or index to go for. So that is my take, like currently in the market, if I just talk about it. And so that is something that we all need to understand. Okay. So that is something from my side. It might be a longer video. So sorry for that. So yeah, so that is something. And I hope it would really help you to make an informed decision, taking into consideration all the fundamental dynamics of the market. Okay, guys. Thank you so much.